In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data. This just reflects the reality of managing an outlook in real time as data comes in. Now, subsequent data may well alter this outlook again, but we shall see. Based on what we know now, there is no urgency in taking that step. So where do I see things standing? I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy. The target range for the federal funds rate has been 5.25% to 5.5% since last July. And I believe that this restricted level is helping to reduce imbalances in the economy and continuing to put downward pressure on inflation. All indications are that the economy continues to grow at a healthy pace. While retail sales and some other indicators suggest a softening in demand this quarter from the second half of last year when growth accelerated, the evidence for a significant slowdown is sparse. Meanwhile, as the labor market continues to add jobs at a rapid pace, some signs point to improvement in the imbalance between supply and demand, but others indicate continued tightness. My judgment on the balance of risk for monetary policy, which I explained in a speech on February 22nd, hasn't changed. The risk of waiting a little longer to cut rates is significantly lower than acting too soon. Cutting the policy rate too soon and risking a sustained rebound in inflation is something I definitely want to avoid. As a result, in the absence of an unexpected and material deterioration in the real economy, I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation. Fortunately, we can wait and see how the data come in before deciding the appropriate time to start lowering the policy rate. The remarkable US economy keeps on chugging along, adding jobs at a rate that over time will keep unemployment near its current historically low rate. But the overall strength of the US economy makes it a fairly easy decision to wait a little longer to get a better understanding of the trajectory of inflation and, when appropriate, to begin easing policy. So thank